the question becomes, what about those corporate tax cuts, which President Trump talked a lot about during his State of the Union address, and as we fully expected? Won't those tax cuts change everything and help the economy quickly catch up with all that froth on the overvalued market? Well, not everyone is sold on that idea either, as we'll talk about just a bit later in the show. Right now, let's welcome our first guest for today, David Hightower. David Hightower is the founding principal of the well-known commodities research and information firm, the Hightower Report. He publishes one of the most widely read daily commodity wires in the world, which is used by many brokerage firms as a primary source of research. He examines financial, agricultural, geopolitical situations around the world, which allows his company to provide analysis and commentary on a wide variety of markets. This includes grains, livestock, precious metals, currencies, bonds, and of course, the stock market. David, welcome to the show.
Good to be here.
Most people at least have heard of the Hightower Report, but for those who aren't familiar with it, what should they know?
Well, we do a lot of hard work, and we do what I think is real market analysis. We pour through the details. We listen to the markets. We have a tremendous amount of experience, 36 years myself. And I think we're a blue-collar economist. We look at the basic principles of the market, but we also seek verification by the hard nuts and bolts on the ground.
So tell me, in 36 years, have the financial markets changed in any fundamental way since you've been doing this? And if so, how?
Definitely they have. Well, logically, the globalization is obvious. The other fact, though, the markets are much quicker now. The markets look further forward. They have a lot more geopolitical and just wide diversity of information to absorb. But they also have a much more potential for what I'd call boom and bust. So the rallies are bigger, the breaks are steeper.
Yeah, and part of that's probably just people being not as long-term based as they had been, years ago. So do you think net, is that a good thing or a bad thing for everyday investors?
I think it might be a bad thing for everyday investors. I try to look at the bigger trends. I try to use the daily action to kind of confirm whether my thinking is accurate and what the market thinks. I think that's always important.
How about so far since the turn of the century? Have you seen the markets changed fundamentally since January 1st, 2000?
Well, logically, we had two major negative events that really injured sentiment. At one point, the markets were expecting some depression of sorts. And so it was probably the worst economic situation in 50, 60 years. But all things considered, I think they've rebounded rather quickly. And as Goldman said today, I think we're maybe beginning to see a reflation.
Reflation, wow. Hey, David, I know you're on a time crunch today, but can you stay with us for just one more segment? We need to take a quick commercial break. Great. And you, too, I want you all to stay with us, too. We have a lot more with David Hightower as soon as we come back. We'll be right back. But right now, I'd like to welcome back David Hightower. David, before the break, you had mentioned something about reflation, a term that I'm sure a lot of our viewers have heard of, but might not understand completely what it means. Can you give us a quick Cliff Notes definition?
Well, I mean, we've come from a long period, as you indicated in the prior segment, a deflationary scenario where we had a lost decade. We pressured prices. We had demand that was so soft that prices would just favor the downside. So we see very little inflation. We see very little upward pressure in prices. But now we're going from holding the beach ball underneath water to seeing the beach ball rise back to the surface of the water, and that comes with wages and commodity prices and interest rates, energy prices, et cetera. It's called reflation, and I think that's upon us, and it will translate into more solid growth going forward.
So you've seen, have you seen the same disconnect that I've been seeing, at least for the last year and a half, between economic growth and stock market growth? Or do you think that the stock market is fairly valued where it is today?
Well, I don't think it's a disconnect. I think that we have the timing. We expect the timing to be immediate. The stock market, the futures markets, economic forecasts are forward-looking, not backward-looking. And the stock market is discounting the future. And, I've traveled 190,000 miles in 3.5 months, I think some 23 countries, China, extensively. And this global synchronized growth is not something to be discounted. And I verify that. I look at how much throughput do we see in crude oil, what kind of consumption we have of soybeans, what kind of consumption of beef. So it's real, even though some people want to continue to doubt that.
So if you feel as though in the next year or two the economy will grow into the forward-looking stock market values of today, then the question is, how much more upside does the actual stock market really have? If the stock market's kind of already factored in this economic growth, then do we see ourselves at least getting back to more normalized growth cycles in the stock market over the next year or two? What are your thoughts?
Well, not to be clipped about it, but it'll keep going till it stops. But I think that it depends on well, how strong and how long is the recovery going to be. But I don't see it ending in the short term. And today was a good example. We saw Treasury yields break out to the upside at the same time that the Dow made new highs in the day. So we're at this inflection point now where yields are starting to creep higher. They could attract some money away from the stock market. But that doesn't mean in the near term, perhaps another 2 or 3 months, that interest rates could go up and the stock market could continue to go up. So I continue to watch every day to see if perhaps the situation's coming apart for the bull camp, but it doesn't appear to be yet.
We broke through a key resistance level, as you know, on the 10-year Treasury rate just in the last week and a half or so. How high do you think the 10-year Treasury rate will go on this level? If you had to forecast that, where would you put it? 3 and a quarter before it backs up again? You tell me.
Yeah, I mean, it's going to be begrudgingly go higher because the central bankers are, they're maybe not tapping on the brakes any longer, but we haven't seen a concerted effort to begin to rapidly remove quantitative easing. So I think it's going to be a very slow and gradual climb out when it comes to yield. Sometimes, though, the market, the cash bond markets globally, actually go do the Fed's work for them. So it could do that. It could do those 50 basis points, as you indicated, if the trade begins to see that from the ECB, Bank of Japan.
In the last 15 seconds or so we have left, are you concerned at all, as I am, that if we don't get the growth that the markets are predicting, again, forward-looking, that we can end up ending up with a flat yield curve?
I think the flat yield curve has absolutely no credibility in the marketplace. We're coming off a historical quantitative easing, a floating of debt, a artificial suppression of what's going on throughout the interest rate structure. So I don't know. I think, but I also think that the U.S. is not the primary game any longer, and sometimes we infatuate ourselves with what is going on with our yield curve.
Yeah, that's very, very true. Of course, a lot of sovereign yields and other countries theoretically weaker than ours are actually even lower. So it's great. That's why I love having people on the show that have different points of view. David, it's been wonderful. We'd love to have you on again the show sometime. So thank you for being here.